So Michael Collins, CEO of Adelphic, we recently sold to Time. We got Jonah Goodhart, Moat, recently sold to Oracle. So is Lorne Brown from Operative and Jonathan Opdyke from HookLogic. And standing in for Bruce Falk at Turn, we have Jeff Crowe from Norwest, long-term board member at Turn. So thank you all for joining. I think this is just an opportunity to share some insights and some thoughts. Maybe I'll kind of start left to right, not to put you in the hot seat, Jeff. But you've actually been a long-term investor in the sector. Definitely saw ups and downs in the space. Turn itself was kind of going through its own turnaround, if you will, when Singtel approached. What made you think about the right time to sell versus playing through for better times?
We had been first invested in Turn back in 2005, so right. It's been a long ride. We had brought Bruce Falk in as CEO, and about maybe 18 months prior to the transaction, and Bruce was really doing very well, kind of engaging the team, rebuilding the team, and driving growth. And we were quite confident in what was going on, and then Singtel approached the company. And you had a chart earlier this morning during the presentation where you talked about basically it was the duopoly and all of the growth in digital media being sucked up by Google and Facebook, and that had really become apparent to us. And so I think as a board member and as a venture investor, you think a lot about know when to hold them, know when to fold them, and we were confident in the team and what Bruce was doing, but at the same time, we felt that if an attractive offer came along, you take it.
Yep.
And so that's what we did.
Excellent. I'm sure that's a similar thought across a handful of these deals. Jonathan, maybe in terms of ultimately selling to Criteo, I know they were a partner initially, and how did that kind of evolve into what became an M&A discussion?
Well, I heard Eric Rosa earlier talking a little
Sure.
bit about some of the long-term relationships, and I actually saw Criteo as an opportunity to build on the vision of what we started at HookLogic, and so I pursued them from pretty early on, saying this is a company we need to
Kind of
have a mutual relationship with, and built a relationship with their team, and partnerships make a big difference as much as anything in exposing team to each other, that recognizing that DNA is similar, talent levels are similar, all the kinds of things that, particularly a company like Criteo that hasn't been a big active acquirer,
right.
They needed to get pretty comfortable with the idea of doing something a little bigger. And so we were their first big one, and we got to experience their first big due diligence process and all that kind of stuff, but a lot of it was already done from partnering, which is a huge advantage.
Right. And we often see that be successful. And how much of, in terms of the time to sell as well, I know you managed to develop significant share in the marketplace. Product offering was one also that, there was always concern that maybe some of the bigger players, Google, others might launch similar capabilities. Was the competitive landscape on your mind when you thought about, kind of partnering up, getting larger?
Mm-hmm. Well, I think it always is to a degree. I think the reason I pursued Criteo was because I felt like we could move faster on what we wanted to do first, and then second, it's better to have deeper pockets and a bigger friend on your side when Google and Facebook come calling.
Right, totally makes sense. So Lorne, you had a competitive process, multiple kind of opportunities to think about. Ultimately, private equity-backed kind of play there. So I guess maybe two questions. How did you weigh partner selection, kind of economics and fit? And then do you see a lot more, as we kind of highlighted earlier today, private equity coming into the space?
Sure, yeah, no problem. So Operative, quickly our customer base became mostly TV companies over the last 5 years. And we saw a future where all things were headed to a targeted TV environment, which Operative, as the leader in impressions-based ad sales, was a nice fit for. And even just 2 weeks ago, Omar Sheikh from Credit Suisse said $100 billion of incremental dollars is going to go to targeted TV, to TV companies, which we joked around in the video session. TV is also video if it's professionally produced. And so for companies like NBC and many other TV companies to grow, they have to get their share of that budget. They have to get it from the digital giants. And so Linda talked a lot about creating a portfolio network, doing partnerships with Apple and Snapchat, doing M&A, making investments. And so it really dawned on us in the middle of last year that our customers, the TV companies, were at war with YouTube and Facebook. And we felt it was our goal to help them with that war. And selling TV and selling digital and everything in between, because there's VOD and specific buyers buying specific media, it's a very horizontal process, right? The buying, selling process extends through the buyer into the enterprise, out through the invoice. And so everything's been horizontal. But like NBC, as you move towards audience selling and convergent TV and programmatic and all these new things, you're really going vertical across all those different things, across execution systems, across measurement, across cost methods like the GRP and the impression now having to coexist. And so we kind of looked at it as, well, if these companies are going to be successful, they have to be big, fast, and easy. And big, they were doing on their own, right? They were building enough scale, but we felt like the fast and easy part was our job. Make it fast-acting technology, make it easy to buy from. And so that's where it came to the strategic process. And we had a lot of inbound interest. We were talking to sort of, when all was said and done, a few players left. There was a strategic, which was a very good fit. A private equity firm, also a very good fit. We still love the team. I still talk to those guys. But Syntec came along, and Francisco Partners had bought them early in April of last year for $400 million. And we felt like that was a great fit because we had the digital infrastructure. They had the linear TV infrastructure for ad sales. We were both innovating on top of that infrastructure. And it just felt like a good match, and we went for it.
Perfect. Appreciate it. Jonah, so ton of questions for you. I think everyone's trying to figure out your playbook and try to run that again. Congratulations, outstanding outcome again. Not the first, but second significant sale you've been involved in with Right Media almost 10 years ago. So similar return. I guess a handful of things. I know we heard Eric talk today about how important the long-term relationship was, both from a business perspective as well as personally. How did that weigh your thinking in terms of picking the right partner, or having had time developing that relationship, with Oracle?
So I think a couple of things. First of all, thank you for having me here, Mark and Terry and team. It's huge. The personal relationship is absolutely huge. In the end of the day, I think people want to partner with, have clients with, do business with people that they enjoy spending time with. I was sort of, and maybe because of a couple of these events, I've had a perspective given to me from others, and that is that we all have sort of a limited road at some point, and we have to begin to, I think, make decisions about the ways that we choose to spend our time in as thoughtful of a manner as possible. And it was something that I hadn't really thought a lot about, because when you're in a startup, you're sort of spending 24/7 just trying to get the next thing done, and it's a roller coaster, right? Something goes well, and you feel like, wow, top of the world, and then go on the other side of the roller coaster, and it goes down, and you feel like, oh my God, this is a disaster, and then you hit that bottom and sort of come back up the other side. And I sort of had a moment of, when Oracle approached us, I had a moment of pause where I felt like I want to be really thoughtful about the next decision that I make and that we make as a company to make sure that we're absolutely maximizing shareholder value for our shareholders, for potentially Oracle shareholders, but that we're also being really thoughtful about what we can potentially do in partnership with this industry. And I think that was the aspect that got me most excited, was to think about, we really are in a transitionary moment. In 2 years from now, we're not going to talk about, quote, linear and, quote, connected TV. Any of that stuff is going to go away. And if any of you have kids, you can see the future, because your kids don't think about those things. Your kids just think about video and the content that they like and the things that they choose to spend their time doing. And so when we look at that future of the world, it becomes really clear that there's a bunch of areas that need to be figured out. And one of those areas, we believe, is measurement. And we think measurement is not going to be, quote, digital measurement. It's just going to be measurement, because all media is going to be digital, in my opinion. And so with that sort of worldview, it also changes the decisions that you potentially make. It changes some of the partnerships that you think about driving. And so I think I paused and took a longer term perspective and asked new questions that maybe I hadn't asked in the last couple of years.
Yeah, and how did you weigh that, the decision, sell now versus continue? You were obviously on a, very aggressive growth curve on your own, and there's always that decision crossover. What made you know now was the time?
I think it's hard. I mean, I think it's funny, when we started Moat, my brother and I said, if we could just get this thing to be, have some level of success, make a little bit of money, and do X, Y, and Z, we would be happy. And then if you get to that point, you kind of go, wouldn't be that happy there. I'd be really happy if we did X. And then if you're fortunate enough to do that, you kind of go, yeah, but I'm not really happy if I get that. What I really want to do, and you sort of get this sense that the goalposts always continue to move. And I've been very...
That's a type A issue, by the way.
Well, I've been very fortunate and very lucky. I've been in this industry almost 20 years. I know a good number of the people in this room, and I think that the thing about this industry is that, by and large, it's just good people who are working hard, doing good work, and trying to honestly help make our industry better. And so for me, it was sort of yes, there's the calculation you go through for shareholders and all of that. But honestly, once that's done, and to your point, we had been very fortunate in some of our past stuff, it wasn't the biggest driving factor for me. Right. But I wanted to do something that felt like we could raise the bar, felt like we'd have a bigger playing field to play with, and Oracle has 140,000 people, so certainly a bigger playing field.
Yeah, that's great. Congratulations again. So Michael, maybe we'll hear about your journey with Adelphic, ultimately being sold to Time. I think in your tenure as CEO, you definitely saw navigating some changing, atmospheric, shall we say, around funding availability, around competitive landscape, et cetera. How did all that kind of contribute to how you thought about ultimately the sale of the business?
Sure, and I think those are two, the competition, the funding environment probably were two of the biggest factors, although in somewhat different ways. Competition, if you're in a space that's worth being in, competition's not going to slow down. They're always going to be there, and the better the space, the tougher the competition, and that just comes down to innovation. And to do that, you need the funds, you need to grow, you need to be able to expand, and that's not unique to us or our space. That's really any company anywhere. But the funding environment and our ability to be able to fund and execute that innovation, that did come back to funding. And as we were enjoying tremendous growth coming through mid-year, but we knew being able to innovate and grow as an independent ad tech company is hard. Being a smallish independent ad tech is not necessarily a comfortable place to be. So even with the success we were having with the partnerships and the growth rate, we knew we needed to get more heft, to have just a bigger footprint in the marketplace. So as we're going out to look to raise our C round to give us the funds to get to that next level, as we were talking this morning, it was the funding market was out there, but what we were finding is that there's a degree of almost unpredictability in it, which is, even though there was some money coming in, the valuations, the amount of risk the VC community was willing to take, seemed to have gone down pretty dramatically, which translates to lower valuations. And so we were, as shareholders, looking at if we were taking the funds we need to get us that heft, to get us the next level, it would have been fairly substantial dilution, which is part of the game. We all know that going in, but getting as most small companies do, a steady stream of knocks on the door from larger companies looking to do M&A. All of a sudden, when you're weighing that against the dilution and the normal 12, 18, 24 months of execution risks that would come with taking that money and trying to get to that next level, all of a sudden those knocks on the door start to factor into the equation. And I think when we started to see some very strong interest coming in, especially from Time, and the term sheets they're putting forward, that started to get to the place where weighing the dilution and the extended time for payback from our shareholders started to make the opportunity for an exit. At that time, it was when you just look at the risk and reward, the shareholders seemed to think that was the appropriate thing to do at that time.
Right. Yeah, I think familiar calculus for a lot of folks in this room if they kind of think about those alternatives. Definitely very helpful.
So Mark, I thought I would just go back to your other question, because
Sure.
I know
Yeah.
you asked me too, but I wanted to let that play out. The financial firms, mainly the private equity firms, are they going to continue to do M&A while the strategics organize their priorities and figure their own stuff out? From my experience in talking to multiple PE firms, what's very clear is that each and every one of them, and there's only 20 that are looking to do
active in the space.
50 plus percent buyouts, are looking for their big deal, right? And they're very much like the public market. They're invested in lots of different industries, in healthcare, and financial services, and manufacturing. And media is interesting, but they don't want to get overly saturated in media. So they're all looking for one big deal where that they can buy a company, help it grow organically, get EBITDA. It's my new favorite term, by the way. I told my my board that I was going to name my second baby EBITDA, and they all applauded. Very different than venture capital.
Get used to it in private equity.
Yeah, exactly. And so similar, you saw, Vista buy MediaOcean, Francisco, buys Operative, merges us with Syntec. They're all looking for that one big deal. And I actually think that there's a lot of people left in that wake who are looking for some big deals that they can build an ecosystem around. There's probably
Private equity investors, you mean, left in that wake? Yeah.
Definitely. And there's still a lot of money on the sidelines. And, we've got a lot to chew on as we continue to get organized with Operative and Syntec, but we'll have our eyes open as well.
Yeah. Excellent. I think we're seeing much the same in terms of interest in the space and getting ready to write those bigger checks. Let me open up. Are there any other, closing comments, words of advice, thoughts, learnings that the panel would like to share?
I guess what I would just add is that, Terry always talks about you don't, the good companies don't get sold, they get bought.
Right.
And I think that's really important. I think that if you spend any time thinking about your strategic path or exit, you're probably spending too much time on that. And from our perspective, if you have an opportunity to build a business that's profitable, I think that you have virtually limitless opportunity. You can raise money, you can grow the company, you can stay private. You don't have to go public anymore. You can go public if you want. There's lots and lots of different options. And so I think getting the focus to be on the business model itself is really, really critical. Because if you can get that, even if it's, you didn't have a perfect model and you're sort of tweaking it to get to the right path, really, really important from my vantage point to ultimately any sort of strategic outcome, because the numbers do matter in the end of the day. Ultimately, all the stuff that we think about as startups, eventually it does roll into a bigger company at some point, whether it's PE or a public company, and the business model matters. The numbers matter. I think we sometimes get sucked into this, how things quote unquote trade, and it's just, I think there's less of, it's not as much as people think it is, I guess is what I would say.
Yeah, it's a very distracting process, and we wouldn't have done it again had we, we would definitely do what we did, which is wait for the market to come to us, and then once we have a few people at the table, hire a banker, and go from there. But every moment you spend on the road and being engaged takes away from the team. And I spoke at a conference that our venture capital company had a few weeks ago, and I talked about the importance of teamwork, which feels so soft, but it isn't. And as the CEO, your job is to make sure your team is functional. And you do that by being around, getting them to engage in conflict, establishing accountability and trust. Because once you have that trust, then those guys can run the business without you, and you can rest assured that your top priorities, meaning the things that are blocking your growth, that you're trying to get out of your way so you can grow organically, can be knocked down. And that's how we were able to get there. And I also think that having those relationships with the PE firms, with the strategic buyers, everyone thinks, oh, the strategic, they know us, don't worry, they know us. They don't really. They didn't really know us. And I spent the last few years trying to get to strategic executives who I knew were the main people making the decisions. And even after all that was done, they barely knew me. And so I can't echo what you said enough. It's get out there, grow the company, be passionate, be a team, and wait for the market to come to you.
And ignore the VCs and ignore the, sorry, Jeff. Jeff passed on us earlier in our life cycle.
Oh, I passed on 2 companies. What are you talking about? This is my anti-portfolio sitting in here. So. I'd like to make a comment just on that. I think if you make your business profitable, you can do whatever the hell you want. If you're out there raising money, and you have to raise money continually because the business is not profitable, I think you have to pay a lot of attention to what's going on in the overall market. And I don't mean your market with your customers. Of course, you have to pay attention to that. But I mean the broader market, because investor sentiment comes and goes in waves, and it overreacts both ways, positive and negative. And CEOs, I think, have to be really mindful of what's going on in the overall market. Turn could have sold 3 or 4 years earlier for probably 3 times the value it ended up selling for, and it's solely because of differences in the market and what was going on. If you don't control your own destiny by being profitable, then you really have to pay attention to what's going in the broader market. And something can be hot, and you think it's going to stay hot forever, and investors are going to overpay, or acquirers are going to overpay forever, and that can change, and then might take 3 or 4 or 5, 7 years to recover. So it's just, you got to build your business, you got to do all that, but unless you're profitable, you also have to keep that in the back of your mind. And good board members should be talking to you about keeping that in the back of your mind. Otherwise, you can miss opportunities. And I don't know if Ben Barocas is still here in the room. Admeld played that brilliantly back in 2010 and selling it on the upswing, right? I was on the board of Admeld. So know when to hold them and know when to take advantage of the market.
I think Admeld worked out pretty well for Google.
Admeld was great. Admeld's the opposite, right?
Yeah.
No tears. We'll be all right.
One quick point. I think, if I took my big learnings away from it, it's persistence. If you're not following a trend line, but you still believe what you're doing is right, our business wouldn't have followed any trend lines along the way, and we still persisted through it. But then we learned to focus. The need to focus and get down to something that can scale. That was probably my biggest learning along the way is, entrepreneurs want to do this, but businesses really need to do this to create the scale to get bought. And then I was just going to add one anecdotal story on knowing the market. Yeah. I went to, you do those meetings with strategics trying to make the interest, and I met with Omar Tawakkol when he was at Oracle, and I told him all about the business, blah, 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 and he's like, why doesn't Criteo just buy you? So there you go.
That's a market signal. There it is. There it is. Well, excellent, excellent. I appreciate everyone spending some time with us today. Congratulations on your exit, and thanks again for allowing Lumen to play a small role in that outcome. Thanks for coming.
Keep up the good work. Thanks.
Thank you.
Thank you.